Many of us dream of, a steady income in retirement, a paycheck that just keeps coming no matter what the market's doing.
Hmm. The security aspect.
Exactly. But how do you build that kind of security when financial products can feel, well, incredibly complex,
Hmm.
almost designed to confuse sometimes?
Yeah, the jargon can be pretty thick.
So today, we're dissecting one specific product, the variable annuity.
A big one.
Right. Our mission for this deep dive is to cut through all that financial lingo, really understand what's going on under the hood, and pull out the most important insights from the source material we've looked at.
Hmm.
We're going to try and make sense of these pretty detailed financial agreements.
And our goal for you, the listener, is to explore not just the mechanics, how these contracts work,
Yeah.
but critically, who they're really designed for, and the crucial questions anyone needs to ask themselves before even thinking about one.
Right.
It's about understanding not just what they are, but why they might or might not be the right fit for your specific financial journey.
Okay, let's start right there with the basics. When we talk about an annuity, what's the core problem it's trying to solve for someone planning retirement?
Well, at its heart, an annuity is basically a contract. It's between you, the owner, and an insurance company.
Okay.
You put money in, could be a lump sum, could be over time, and in return, the company promises to provide future income.
Like turning savings into a paycheck.
Exactly. Think of it as converting a pile of savings into a stream of payments, usually for your retirement years.
And these are long-term things, right? Not short-term plays.
Oh, definitely. These are long-term investments often used to supplement other retirement plans, like your 401k at work or an IRA.
That sounds like a powerful idea, turning savings into that reliable paycheck. But what's one of the biggest selling points, especially thinking about taxes?
A really significant benefit is tax-deferred growth.
Okay, what does that mean exactly?
It means the money inside the annuity can grow, earn interest, whatever. And you don't pay taxes on that income or growth until you actually start taking money out, the distributions.
So no yearly tax bill on the gains like some other investments.
Right. It's not generating those taxable capital events along the way. Now, when you do take money out, any taxable part is taxed at ordinary income rates, like your salary.
But there's always a catch, isn't there? What's the trade-off for that tax deferral?
Well, yeah, the trade-off is you're often looking at pretty long holding periods, and there can be significant surrender charges or tax liabilities if you need to pull funds out too quickly.
Surrender charges meaning fees for getting your money back early.
Exactly. And it's also important to remember most annuities are non-qualified. That means you put in after-tax dollars,
Okay.
but the interest, the growth, then accumulates tax-deferred. The real insight here, I think, is you need to rigorously compare if the value of that tax deferral truly outweighs those additional costs and restrictions.
Especially compared to other retirement accounts.
Right, like IRAs or 401ks that might have lower fees and also offer tax benefits, sometimes even better ones, depending on your situation.
Okay, so we've got the general annuity concept. Now let's get into the two main types, fixed and variable.
Yeah.
What's the core difference?
Okay, so with a fixed annuity, it's pretty straightforward. The insurance company promises you a guaranteed fixed interest rate.
Like a CD from an insurance company.
Sort of, yeah. And importantly, they, the insurance company, bear all the investment risk.
Okay.
Because of that guarantee and the company taking the risk, fixed annuities are not considered securities.
Ah, so less regulation.
They're regulated solely by state insurance law. No SEC involvement.
Got it. And the variable kind, I'm guessing that's where the name comes in, and the risk picture changes.
Exactly right. With variable annuities, the returns aren't fixed. They fluctuate. And this is the critical distinction. You, the investor, assume all of the investment risk.
Okay, so the potential for higher returns, but also the potential for loss.
Precisely. And because you take the risk, variable annuities are considered securities, which means they fall under the oversight of the SEC, fine NRA, and state insurance regulation. Much more oversight.
And there's a key document involved.
Yes. A prospectus must be delivered to you before any sale can happen. That outlines all the details, risks, fees, everything.
So if the investor takes on all that risk with variable annuities, why were they even created? What was the gap they were trying to fill?
That's a good question. They were actually designed to offer greater potential protection against inflation compared to fixed annuities.
Because the returns could potentially keep pace with rising prices.
Potentially, yes. especially during times when inflation is high. Plus, as the contract owner, you get some control over how your money is invested during that initial accumulation phase.
Unlike the fixed kind where the insurer calls the shots.
Exactly. You get to choose from different investment options.
Okay, let's dive deeper into the nuts and bolts then.
Mm-hmm.
There's a common misconception, right? Even though insurance companies issue them, they're not really life insurance.
That's a great point to clarify. While they come from an insurance company, variable annuities are absolutely not a form of life insurance. They function as investment vehicles.
Got it.
And because they're securities, any firm selling them has to be an SEC-registered broker-dealer.
And there are people selling them.
The sales reps. They need both a state insurance license and either a Series 6 or Series 7 FINRA registration.
Wow. Okay, so a lot of hurdles to clear.
It shows you there's a serious amount of oversight, which kind of underscores just how complex these products can be.
Definitely feels that way. Now, when someone actually decides, okay, I want to start getting payments, there's a term for that, right?
Yeah.
Annuitization.
Yes, annuitization.
What actually happens when you annuitize? What changes?
This is a really big step. Once you annuitize and start getting those regular payments, you essentially give up control of the lump sum you initially invested or accumulated.
You can't just ask for it back.
Nope. It's like you've converted your savings into a permanent income stream. You can't just go back and withdraw the principal whenever you feel like it. That money is now irrevocably committed to paying you, either for life or for the specific period you chose.
And the payments themselves, they aren't fixed like in a fixed annuity.
Correct. From that point on, your payments will fluctuate based on the performance of the investments in what's called the separate account.
Okay, and here's the key part.
This is critical. The insurance company does not guarantee a minimum rate of return for variable annuities once you annuitize. The performance drives the payment.
You mentioned the separate account. Sounds important. What exactly is it, and why is it unique to variable products?
The separate account is a really fundamental structure here. Its assets are legally segregated, kept apart from the insurance company's general funds, their main operating account.
Why does that matter?
It matters hugely because all the investment gains and losses are specific to that separate account, not tied to the company's overall financial health.
Okay.
And crucially, if the insurance company itself runs into financial trouble, like insolvency,
Yeah.
creditors cannot touch the assets in the separate account. They are protected for the annuity holders. That's a significant layer of security.
So your money is walled off,
Yeah.
essentially.
Exactly. Now, creditors can go after the company's general account assets, but not the separate account. And generally, these separate accounts are registered as investment companies under the Investment Company Act of 1940.
So it's like my money is in its own protected bucket. What's actually in that bucket? Do I get choices?
Yes, absolutely. Within that separate account, you'll find what are called sub-accounts.
Subaccounts, okay.
Think of these as essentially mutual fund options within the annuity wrapper. This is where you actually choose how your money gets invested.
Like growth funds, bond funds, that sort of thing.
Precisely. Everything from aggressive growth options to more conservative income or bond funds, just like you might choose for a 401k or an IRA, but it's all inside this annuity structure.
And I choose how to allocate my money.
Yes, as the contract owner, you decide how to allocate your payments among these different subaccounts, and you can usually transfer money between them if your goals or the market changes.
Are they all variable? Or is there a safer option?
That's a good point. While most subaccounts are tied to market performance, meaning their value goes up and down, it's worth noting that sometimes one subaccount might offer a fixed interest rate.
Ah, like a mini fixed annuity inside the variable one.
Kind of, and that fixed rate option is typically guaranteed by the insurance company's general account. But for all the other subaccounts, the variable ones,
I take the risk.
you, the contract owner, assume all the investment risk. Market risk is the primary risk you face there, which, again, reinforces why variable annuities are securities, needing SEC registration and that prospectus we talked about.
Okay, we've peeled back the layers on what a variable annuity is and how it works. Let's talk about the timeline, the journey your money takes. What are the main phases?
Right. If we look at the whole life cycle, most variable annuities have two distinct periods. The accumulation period, which is the pay-in phase.
When you're putting money in.
Exactly.
Yep.
And the annuity period, which is the payout phase, when you start receiving income.
Okay, so during that first part, the accumulation period, you're making contributions. How is the value tracked? Is it like shares of stock?
It's tracked using something called accumulation units. Think of them like shares in the subaccounts you've chosen.
Okay.
These units are purchased at their net asset value, the NAV. And that NAV is calculated at the end of each business day using forward pricing.
Forward pricing.
hmm
What does that mean in practice?
It just means when you put money in, the price you pay per unit isn't determined until the market closes that day, and they calculate the NAV. You get the next available price, not an instant quote.
Got it. And the value of these units goes up and down?
Naturally, yes. The value fluctuates with the performance of the underlying investments in the separate accounts, sub-accounts.
And do all my contributions go straight into buying units?
Not quite. It's important to know that any applicable commissions and charges are usually deducted before the rest of your money actually buys those accumulation units.
Okay, so fees come off the top first. Now, during this accumulation phase, before I start taking income, what can I do with the money? Can I get it out? What if the worst happens?
You do have some options, but they come with strings attached. You can usually cash surrender the annuity.
Meaning cancel it.
Yeah, cancel it or just withdraw part of the value.
Right.
But, and this is a big, but doing that often triggers those surrender charges we mentioned.
The early withdrawal fees.
Right, which usually decrease the longer you've held the annuity. Plus, you'll have to pay ordinary income tax on any growth, any increase in value you withdraw.
And is there a minimum I'm guaranteed to get back if I surrender?
No, that's key. There's no guaranteed minimum cash surrender value. Because the underlying investments fluctuate, you could actually receive less than you originally invested if the market's down when you surrender.
Ouch. Okay, what else? Loans.
Yes, loans are generally allowed against the cash value.
What's the benefit of a loan versus just withdrawing?
The main advantage is that taking a loan usually avoids triggering surrender charges and potential taxes and penalties if you repay the loan within the agreed time frame.
And if I don't repay it?
Then it's treated like a withdrawal, a taxable distribution, potentially subject to penalties if you're under 59 and a half.
Okay. And the death scenario during accumulation?
Right. This is where variable annuities often differ quite a bit from, say, just owning mutual funds. They frequently include a death benefit.
How does that work?
If the annuitant, the person whose life the contract is based on, usually the owner dies during the accumulation period, the beneficiary typically receives the greater of two amounts.
Okay.
Either the sum of all the payments made into the annuity or the annuity's actual market value on the day of death.
Can you give an example?
Sure. Let's say you paid in a total of $50,000 over the years, but due to a market downturn, the annuity's value when you pass away is only $45,000.
Yeah.
Your beneficiary would still receive the full $50,000, the amount you paid in.
So it protects against dying when the market value is low.
Exactly. It provides a basic minimum return for your heirs in that specific scenario. However, it's really important to remember this guarantee, this death benefit, isn't free.
It's factored into the fees.
Absolutely. It's an added cost built into your ongoing fees, the mortality and expense charges. For many people, just buying a separate, potentially cheaper term life insurance policy might achieve a similar goal for their beneficiaries without adding extra costs to their retirement savings growth.
That's a really important comparison to make. Okay, so after accumulation comes the annuity period, the payout phase. What's the fundamental shift once those income payments begin?
Well, this goes back to that annuitization point. Once you flip that switch and the payments start, you cannot typically surrender the annuity or freely withdraw lump sums anymore.
You're locked into the income stream.
Pretty much. We've converted that accumulated value into a promise of income. And remember, those payments will still fluctuate based on the performance of the assets in the separate account.
How are the payments calculated then? Is it still based on those accumulation units?
Not directly. At the point you annuitize, your accumulation units are converted into annuity units.
Annuity units. Okay, a new term.
Right. Think of these as a fixed measuring stick that helps determine the dollar amount of each payment you receive. The number of annuity units you get is fixed at the start of the payout phase.
But the value of each unit can change.
Exactly. The value of each annuity unit fluctuates with the sub-account performance, which makes your payment amount vary over time. The actual dollar payment calculation is complex. It factors in your age, gender, life expectancy, the specific payout option you choose, and something called the assumed interest rate, or AR.
Wow, okay. A lot of moving parts. Given that you're locking in, it sounds like choosing the right payout option is incredibly important. How much choice do you actually have there?
You actually have quite a bit of flexibility, and this is where your personal circumstances and goals really matter.
Like what are the main options?
Well, there's a straight life annuity. This typically provides the highest possible monthly payment.
Highest payment sounds good.
It does, but it pays only for as long as you live. The moment you pass away, Payments stop completely, even if that's after only one payment.
Whoa. So nothing for a spouse or kids.
Nothing for a beneficiary. It carries the most risk in that sense. Outliving your payments isn't the issue, but dying early means the insurance company keeps the rest. And also, that death benefit we talked about during accumulation, that ceases upon annuitization.
Okay, so high income but high risk for heirs. What if I want to make sure someone gets something?
Then you might look at a life annuity with period certain.
How does that work?
You still get payments for life, but you also choose a specific period, say 10 or 15 years. If you die before that period ends,
Yeah.
the payments continue to go to your named beneficiary for the remainder of that period.
Example.
Sure, you choose a 15-year period certain, you live for 5 years after payments start and pass away. Your beneficiary would receive payments for the remaining 10 years.
So it offers a balance between lifetime income and some beneficiary protection.
Exactly. Another popular one is the unit refund life annuity.
Unit refund.
This also provides payments for life. But if you die before the total payments you've received equal the value of the annuity units when you started the payout phase,
Right.
the remaining value is paid out to your beneficiary, either as a lump sum or continuing payments until that original value is reached. It ensures the full initial value gets distributed one way or another.
Got it. Yeah. Exactly. What about covering more than one person, like a couple?
For that, there's the joint and last survivor life annuity.
Sounds like what it does.
It is. It makes payments to 2 or more people, typically a married couple. If one person dies, the payments continue to the survivor.
For their whole life.
Usually, yes, although sometimes the payment might reduce after the first death. But the key is, payments only stop completely upon the death of the last survivor.
So you could use it to make sure, say, both spouses have income for as long as either one lives.
Exactly. Or maybe a grandparent wants to secure income for both their child and grandchild. It provides that longer-term security for multiple lives. Choosing really involves balancing your own income needs versus wanting to leave something behind.
That's a lot of detail. Definitely enough to make your head spin a bit.
Yeah.
Let's maybe take a quick breath and focus on the costs. This seems crucial. You mentioned earlier that your whole contribution doesn't get invested because of charges.
Absolutely. Understanding the fees is vital. Transparency here is key.
So what are the main charges someone needs to be aware of? Let's start with getting money in or out.
Okay. When it comes to sales charges, most variable annuities use what's called a contingent deferred sales charge, or CDSC.
We mentioned the fee for withdrawing early.
Right. It's similar to how Class B mutual fund shares used to work. The charge typically declines over several years and eventually disappears.
Is there a maximum charge, like with mutual funds?
Interestingly, while mutual funds generally have an 8.5% maximum sales charge limit, variable annuity sales charges have no statutory maximum. FINRA just requires them to be reasonable.
Reasonable sounds a bit vague.
It can be. That's why you have to look closely at the specific contract. Then there are the ongoing expenses. These are deducted directly from the separate account's investment income or assets year after year.
Okay, what kinds of ongoing expenses are typical?
Well, first you have management fees. These go to the investment advisor managing the underlying sub-accounts, just like with a regular mutual fund.
Makes sense. What else?
Then there are expense risk charges. These basically compensate the insurance company for the risk that their actual administrative costs might be higher than they estimated. They guarantee the expense level won't exceed a certain amount.
All right.
You also have standard administrative expenses costs for record keeping, sending statements, processing transactions, things like that.
Pretty standard stuff. Is there anything unique to annuities?
Yes, the mortality risk charges, often called M&E charges, mortality and expense.
Mortality risk. What does that cover?
These compensate the insurance company for 2 key promises, 2 risks they take on. First is the mortality guarantee. They're pledged to provide lifetime income payments even if you live much longer than statistically expected.
So protection against outliving your money.
Right. And second, it covers the cost of that death benefit guarantee we discussed, the one that pays out if you die during the accumulation phase when the market value is below your contributions.
So those insurance features, the lifetime income and death benefit, they come at an explicit cost through these M&E fees.
Precisely. They aren't free benefits. They are insurance components you pay for through ongoing charges deducted from your investment returns.
Okay, that helps clarify the cost structure. Now, speaking of taxes again, you mentioned qualified and non-qualified annuities. Can we briefly touch on qualified annuities? Who can get those?
Sure. Qualified annuities are a special type, tax-deferred, but they can only be set up by certain employers, specifically nonprofit organizations like under Section 403(b) of the tax code, or public school systems.
So not something most people can just go out and buy.
Correct. It's tied to employment with those specific types of organizations.
What makes them unique from a tax standpoint?
The big difference is how contributions are often made. Pre-tax. This means the money going into the annuity is excluded from your taxable income in the year you contribute.
Can you give an example?
Yeah. Imagine a public school teacher earns $35,000 a year. If they have $2,000 withheld from their pay and put into a qualified annuity, like a 403(b) plan, their taxable income reported on their W-2 might only be $33,000. They get an immediate tax benefit.
That sounds great up front. What's the catch later on?
The catch is because you contributed pre-tax dollars and got that upfront deduction, your cost basis in the annuity is essentially zero. Meaning when you eventually take money out in retirement, every single dollar, not just the growth, but the contributions too, is taxed as ordinary income.
Ah, so you pay taxes on the whole amount later instead of just the earnings like with a non-qualified annuity.
Exactly. It's a trade-off. Tax deduction now versus paying tax on everything later. Understanding that future tax liability is really critical.
Okay, good distinction. Before we wrap up, there's one more related product worth mentioning briefly. Equity indexed contracts, or EICs. You said they're kind of a hybrid.
Yeah, they try to blend features of both fixed and variable annuities. They're interesting.
But what makes them unique enough that they often aren't registered as securities, unlike variable annuities?
This is fascinating. EICs typically do not need to be registered with the SEC as securities. The reason is key. They offer a minimum guaranteed rate of return, much like a fixed annuity.
So there's a floor. You can't lose your principal due to market drops.
Generally, yes. There's a guaranteed minimum, often protecting your principal from market loss. But they also offer upside potential that's linked to the performance of an equity index, like the S&P 500. That part feels like a variable annuity.
So safety net plus potential growth.
Kind of. It's that guaranteed floor, that minimum return, that usually exempts them from securities registration. The insurance company retains the downside risk related to the guarantee.
It sounds appealing getting some market upside with a safety net. Are there limits on that upside?
Oh, definitely. The potential gains are usually limited in several ways. One common way is through a participation rate.
Participation rate.
Yeah. This determines what percentage of the index's gain you actually get credited. For example, an EIC might have an 80% participation rate if the S&P 500 goes up 10% in a year.
You don't get the full 10%.
Nope. With an 80% participation rate, your account would only be credited with 8%. 80% of the 10% gain. There might also be caps on the maximum return you can get in a year or other limiting factors. You rarely get the full index return.
Okay, so tempered upside. What are the main things someone should consider if they're looking at an EIC? Are there downsides?
Well, like other annuities, they offer tax-deferred growth. But it's crucial to understand that you can still lose money if you surrender the contract early.
Not from the market, but from fees.
Exactly. Losses on early surrender typically come from fees like administrative expenses, those contingent deferred sales charges, CDSCs, or premature distribution tax penalties, not usually from market declines hitting your principal, thanks to the guarantee.
And suitability. Who are these not right for?
Again, similar concerns as variable annuities. EICs are generally not suitable for all investors, especially older individuals who might need access to their money sooner rather than later for potential medical or living expenses.
Why specifically?
Because the surrender periods on EICs can be very long, sometimes up to 15 years. They're definitely not for short-term investors or those needing liquidity. It really boils down to whether that limited capped upside potential is worth locking up your money for such an extended period compared to other options.
Right, which brings us back to this critical issue. Given all the complexity, the fees, the long terms, suitability. How does the financial industry try to ensure someone isn't sold a variable annuity or even an EIC that's totally wrong for them?
Suitability is, or should be, the crucial gatekeeper. It's paramount.
Who are variable annuities generally best for then?
Generally speaking, they might be considered for investors who can truly handle fluctuations in value and their potential future income stream, who understand equity-type risks, and are specifically looking for a potential hedge against inflation over a very long time horizon.
And who are they generally not suitable for?
They are often not considered suitable for senior investors.
Why is that emphasized so much?
Mainly because of those long holding periods and the potential lack of liquidity. Seniors may be more likely to need access to their funds for unexpected health costs or living expenses, and surrender charges or tax penalties could be really damaging. Variable annuities are really geared towards individuals with long-term investment goals.
How long is long-term in this context?
We're usually talking at least 5 to 7 years, often much longer, where the person genuinely doesn't anticipate needing access to those specific funds.
Okay. Beyond just the time horizon, what does FineRI actually require advisors to find out about a client to determine suitability? You mentioned they do a deep dive.
They really do. Fin and Raw rules are quite strict here. The advisor or salesperson must make reasonable efforts, which is interpreted pretty broadly to gather extensive information about you.
Like what specifically?
Things like your age, your income, your overall financial situation and needs, your investment experience, your investment objectives, your time horizon for the investment, the intended use of the annuity,
Okay.
your existing investments and assets, your liquidity needs, how easily you need to access cash, your overall net worth, your risk tolerance, and very importantly, your tax status.
Wow, that's comprehensive. It's not just a quick chat.
It shouldn't be. It's about painting a full picture to ensure this complex, often expensive, long-term product genuinely aligns with your specific circumstances and goals.
And once the advisor gathers all that info, who makes the final decision on whether the sale can proceed? Is there another check?
Yes, there's a crucial step called principal approval.
Principal meaning a supervisor.
Exactly. Once the sales representative completes the application and gathers all the required suitability information, the entire package, including your check or transfer forms, must be sent promptly to their firm's Office of Supervisory Jurisdiction, or OSJ.
And what happens there?
A registered principal, a supervisor with specific qualifications, reviews the entire application. They have up to 7 business days from the time the OSJ receives the package to make a determination on whether the proposed transaction is suitable for you based on the information provided.
So, a second set of eyes, specifically looking at suitability.
Correct. It's designed as another layer of investor protection before the transaction is finalized and the money is formally invested.
Okay, one last point on suitability.
Right.
What about switching annuities, moving money from an old one to a new one? I think you mentioned 135 exchanges earlier.
Yes, 135 exchanges. These allow you to transfer funds directly from one annuity contract to another without triggering immediate taxes on the gains. On the surface, that sounds beneficial. But these exchanges require intense scrutiny from that reviewing principal. Why? Because there can be hidden downsides for the investor.
Such as?
The principal has to carefully check if the exchange means you'll face a new surrender charge period with the new annuity, or if you might be losing valuable benefits or riders attached to the old contract.
Or paying higher fees.
Or paying higher fees and expenses in the new contract. They also look closely for any pattern of exchanges, especially if you've done one within the previous 36 months.
Why that time frame?
Because frequent exchanges can be a red flag for churning. That's where an advisor might be recommending switches primarily to generate new commissions for themselves rather than for your benefit. It's a serious regulatory concern. So 35 exchanges can be appropriate, but they need very careful justification and review to ensure they're truly in your best interest.
Got it. So bringing this all together, the complexity, the fees which are often higher than mutual funds, the long terms, the suitability hurdles, where does this leave the average person thinking about retirement saving?
Well, it circles back to a point Finer often emphasizes, and it's a common piece of financial planning advice. Because annuities, particularly variable ones, tend to have higher overall expenses than comparable mutual funds you could hold in other accounts.
Yeah.
The general recommendation is usually to exhaust your contributions to employer-sponsored retirement plans first, things like your 401k or 403b, and also fully fund your IRAs if you're eligible.
Why prioritize those?
The big advantage, especially with traditional 401ks and IRAs, is that they are typically funded with pre-tax contributions. You get that immediate tax deduction plus tax-deferred growth.
Whereas most variable annuities people buy are non-qualified.
Right. Non-qualified variable annuities are funded with after-tax dollars. You don't get an upfront tax break on the contribution. Only the earnings grow tax-deferred. So from a pure tax efficiency standpoint, you often get a bigger immediate benefit by maximizing those pre-tax employer plans and IRAs first before considering a non-qualified annuity.
Wow. We have certainly covered a lot of ground here, really navigating the very complex landscape of variable annuities, from their basic structure, the tax rules,
The separate accounts.
sub-accounts,
Yeah.
all the different payout options, and critically, those suitability factors and costs.
And as you can hopefully see, really understanding these products, the good, the bad, the complex, is absolutely crucial if you're going to make informed financial decisions. It's not just about what they are, but how they genuinely fit or don't fit into your bigger financial picture, especially given all those nuances and costs involved.
So what does this all mean for you, the listener, as you think about your own retirement planning? Here's maybe a final thought to chew on. Given the inherent complexities we've discussed, the very specific suitability requirements, those often significant fees, and the long lockup periods, how can you best determine if the potential benefits, like tax-deferred growth and maybe some inflation protection, truly outweigh all those considerable downsides for your unique financial situation? It's definitely something to mull over, isn't it?